Hello, beautiful friends. Today, I'm excited to have Kevin de Patoul on the show. Kevin, you are the CEO and co-founder of Keyrock, a leading crypto market maker founded in 2017 with a mission to empower tokenized economies. Welcome to Crypto Backstage, Kevin.
Thank you very much, Lindsay. Thank you for having me on.
In a minute, we'll unpack the role of a market maker, what OTC desk and option desk mean, and especially in the digital asset space. We'll also talk about your recent admission into the Tokenized Asset Coalition, which aims to drive more than 1 trillion in assets on chain. And you may tell us more about the Accelerator program that you kickstarted in 2023. But before we dive in, can you tell us, please, a bit more about yourself and what you were doing before Keyrock?
Sure, yeah. So my name is Kevin. I'm the co-founder and CEO of Keyrock. So I launched the company with two co-founders in December 2017. Before that, quite surprisingly, I did not work in a hedge fund. I did not work in a bank. Actually, I worked in management consulting in a company called Roland Berger, still with a focus on financial services, right? I studied finance as well, but so I worked in consulting, and that's when I stumbled upon Bitcoin in 2014. Started to be more and more interested by it. Started to try to understand why there was so much enthusiasm around it still, back then, even more so, later on around 2017 with all the ICO craze. And so we did a bit of work with my two co-founders, whom I eventually met, to understand what the added value was and why it made sense, what part of it did not make sense. And that's basically all this path, this journey that led us to eventually create Keyrock in December 2017.
Amazing. Yeah, I found, so were your co-founders at Roland Berger with you, or you knew them from before?
No, actually, I did not. So I met them. I met them in the course of the year at an event, like a crypto event in Belgium, which I attended, and quite fittingly, I guess I met them at the bar there, and we just struck a conversation, discussed a bit what were our areas of interest around digital assets, cryptocurrencies, trading, and the places the things that we found interesting or not so interesting on the market, the problems that we saw on the market, and one thing led to another, and we discussed more and more over the following month, and that's how we launched Keyrock. I mean, initially when we looked at this, the way we looked at it is that why are ICOs so popular, right? This was in 2017. I think, of course, 3 years already after Ethereum's ICO, but it's kind of the peak of the ICO craze back then, and we saw those projects raising tens, hundreds of millions in minutes, and we wondered, why. And so we compared it a bit, and I think that's what ICOs were back then. It's a bit of a crowdfunding campaign, a kind of a Kickstarter campaign where you
Exactly.
would, just buy a token in the hope they would eventually be useful in a network. But the main difference with it is when you have the token, you have an actual potentially liquid asset. It's not like you just have a Kickstarter coupon and then you can just hope to redeem it for the first product. You actually have an asset that you can trade, you can put on market. And so we saw this potential liquidity as really the main added value, all other things being equal, of tokenizing assets. But since markets were also very fragmented and immature, it was the case in 2017, but to some extent still today, hopefully a bit better, in part thanks to our work. But we saw that liquidity was also a very big issue. So with liquidity being both the main potential added value of digitizing assets and a major issue on the market, is really putting the two together that eventually led us to create Keyrock, with indeed the vision to provide liquidity to all digital assets, knowing that for us all assets will eventually be digital. But that's, I guess, part of a later part of the discussion.
Yeah, we'll get back to that. So maybe when you were probably iterating on ideas, what to do, maybe also do an ICO, because it looked like super easy to raise millions, as you said. Was this like this? Like you iterated on a wide range of topics, or were you very clear from the beginning that market making or providing liquidity were the space you wanted to play in?
So, I mean, there's definitely a lot of iteration around. There's always iteration around exactly how you're going to solve the problem. But we were quite fast as at identifying the problem, as I said, so really seeing liquidity and liquidity at scale. That's something that was both extremely important and clearly missing on the market. So that problem was identified quite fast. But then once you've identified this, there's still a whole spectrum of potential solutions in between. How do you provide liquidity at scale? Do you want to be just a prop trading shop? Do you want to be an arbitrage fund? Do you want to be a service provider? Do you want to be a tech provider? Do you want a bit of everything? So there, of course, there was always iteration, or especially, of course, in the early stages. But it continues to be the case where you need to adapt to the markets, a market reality that continuously changes. Sorry. On the ICO part, that wasn't really ever a topic for us, because the way we looked at it, we were not selling a product. Like we didn't see anywhere where a token would make sense for us. And so we've had a very clear policy: if something doesn't make sense, let's not do it. And so that really wasn't ever an option or something that we considered. No.
Okay, so before we jump into like your business model, I just want to come back to you yourself. So as you said, you were a strategic consultant, which I know a little bit about as well. And typically some people say, okay, consultants, they're not very hands-on people, therefore they're not great founders, because after a short period of time they may get bored, they may not be as good as to grow a team, etc. Do you believe that to be true? And how did you feel? Were you always someone who wanted to become an entrepreneur and have their own company, or did it grow on you, kind of meeting your founders?
No, I met my co-founders because I was looking, I was looking for people and opportunities to launch and start my own thing. So that's something I always wanted to do. While I was at Roland Berger, actually, I took a sabbatical for 4 months to do a coding crash course it's called Le Wagon, to learn how to code, So it's something that was always there. Like, I wanted to have my own business. I was always very interested in everything, there was information technology and digital technology. So that's kind of was always there. Now, whether management consultants make good entrepreneurs or not, like I have a sample of one, so to speak. So it's a bit tough for me to judge. But yeah, indeed, the very early stages of launching a company are very, very far from the reality of a management consultant, right? So that is true, because when you work at Roland Berger, when you work at McKinsey, you work with the board of directors in very large corporations on things that are extremely structured and process driven, which is the absolute opposite of an early stage company. So there is quite a bit of discomfort there, and there was, definitely. But at the same time, I think that the skills that you learn as a management consultant in terms of of structure, of work ethics, of communication, all of diplomacy as well, when you have to manage, clients on difficult projects. I think that all of this is actually very useful when you launch a company and when you make it grow. But definitely, there's also a lot of discomfort involved, because at the beginning, as a consultant, you're a bit of a sociopath when it comes to structure and details, right? Because everything has to be perfect. And then you launch a company, and it's absolute chaos every day. So clearly it's a different world, but I do think that one can be very helpful for the other.
Okay. And so you were in the middle of your sabbatical, you were going to probably lots of events in and around Belgium, and then you met these two co-founders. So were you looking for specific skill sets, etc., specific type of skill sets in your co-founders, or how did you guys select each other?
I think there's a big chunk of luck involved as well, right? Because it's not like I was systematically looking for a very specific profiles and of co-founders and just and had a structured process to find and need a date, right? It's just that we met, we discussed, we had the same kind of passion for the markets, the same passion for digital assets, the same passion for potentially entrepreneurship, and so we took a leap of faith and said, okay, let's give it a try. Of course, when I considered the options, and when they considered the options of continuing our separate ways or actually getting together to work on something, our mutual skill sets were very important. I think that the complementarity is the most important thing to have a successful association of founders. You want to have people that bring very different skills to the table, and for anyone who's met me and my two co-founders, we are very different. We focus on different things. Of course, that helps at the beginning because it makes sure that you get the biggest bang for your buck, so to speak. If you have three people that all focus on the same thing, you might as well just have one. So that's where complementarity is important, but it's also super important as you grow, so that each individual can grow in a developing business with very specific focuses and very specific competences. So I think that complementarity is the number one most important thing for me. The second being transparency. I think being able to
Trust and transparency,
transparently and in a trusting environment, communicate and name problems as they arise. That's also the second part that for me was very, very important. But there was luck involved. It's not like I had neither they had a very clear process. Let's find somebody. These are the 5 skills and so on and so forth. There's also a bit of a leap of faith, right?
Yes. Well, yeah, I can definitely imagine that. And maybe, so this is something I don't know, did you join an incubator or any kind of structure that would help you get started? Maybe raise well?
So we did. So we started a kind of I don't know if it's an incubator, accelerator. Like I guess incubator is right, given how early stage we were. But so we were started at KBC. So it's kind of an incubation program that was back then sponsored by the bank, KBC, which they were coaching, but also there was office spaces available for free, which was a big chunk of the appeal for us as well. Plus being part of a network of other startups. So we did that. It did not really help us to, like, the focus was not really on raising money. The main part was kind of a support network of potentially lawyers and so on that we could speak to as part of this setup, plus free offices. That's kind of what we got from it. And then after that, for the fundraising, it was something that we did kind of separately and outside of the accelerator.
So did you after how long did you raise and how much did you raise?
So actually we raised immediately almost. So we constituted the company in December 2017. We closed a pre-seed round of just 1 million in March 2018. So basically when we founded the company, we were already in the process of closing the round. So that was kind of immediately, right?
Okay.
And then after that, we raised subsequent Series A and Series B, with the Series B being a bit more than a year ago, where we raised 72 million. So that was a bit more meaningful, I guess, as a funding round. Thank you. But yes, we raised actually quite fast in the life cycle of the company.
Okay, and why is that? Is it because I can imagine a market maker involves like high frequency trading, some trading desks, etc. So it's quite capital intensive, I can imagine.
So no, it is capital intensive, definitely. I mean, it can be also efficient depending on how your deals are structured and how you work with clients or not with clients and so on and so forth. So there are different ways to go about it. I mean, initially, the reason we raised was like when we raised money, we're not live trading yet. It's simply like we needed money to build the tech and to make sure that we had something at a certain level of quality that would allow us to be scalable on the long run. So initially, it wasn't trading capital. It was really kind of to develop or like hire the team and start to have a proper first proof of concept and MVP and get started, right? So initially it was more to build the tech than anything that was really trading related.
Okay, so this is really interesting, and for me has been a source of pondering for a long time. So the cold start problem, right? So you have kind of no track record yet. How do you attract your first client, and from that, more clients in a way that is scalable?
So I think that our experience at Keyrock in that might be a bit biased because we had no track record, but in an industry that had no track record. So nobody had a track record. Crypto in 2017 like half the people we spoke to had no clue what market making was, right? So
Were
the
there a lot of
reality is that, so I mean, a lot, no. I mean, the thing, it depends, right? Market making, you open a, I don't know, you opened an exchange. I don't know which exchange you personally trade on. If you do, I don't know, we're in Europe, you open
many?
Bitstamp, you open a buy order, a sell order, there you go, you're a market maker, right? So anybody can be a market maker. But then the number of market makers that were actually doing this professionally, and I mean, we did it professionally from the start, not that scale at first, but with the ambition to scale it and to really do it well. There were some, clearly, like there were some competitors already, some of them that are still competitors today, others that disappeared. But so we're not alone, but the entire, there was a lot of amateurism still, it was a very, very immature market back then in 2017. So my point here is that our lack of track record was less of a problem because there weren't many people with an actual track record that were looking to do, algo trading and market making in crypto only in 2017. So it was less of an acute problem. If we were to launch now, with the background that was ours, and we were, maybe it would be more of a problem. But back then it wasn't. So there was a bit more of the mindset we had was just, we understand what we're doing. We believe it makes sense. There is a clear need on the market. We want to do things, well, the proper risk management, and make sure we do things carefully as well, given the volatility of this asset, of these assets. And so we just went for it. And slowly but surely, you start convincing the people that you can convince, and then you kind of go up the food chain, so to speak, to grow the business. But it's at the end of the day, it's just about, worst case scenario, you get a no. But if you don't ask, you'll never know. So we just went for it, and eventually it worked more and more.
It compounded. Okay. Maybe it's a good time to define what a market maker is. I'll give my definition, and then maybe you can make it a bit more, corrected or make it more sophisticated. So essentially, market maker helps maintain liquidity for a certain asset or token in cryptocurrencies. And to do that, they buy and sell consistently in an order book. Is that
Yes. So yes, I mean, I think that captures the gist of it. I would say that this is not only linked to cryptocurrency or digital assets. Like a market maker is something that it's a role that is there in any market.
Yes.
Any market has one. Indeed, our core capability is pricing. So we make prices both on the buy side and the sell side to ensure that there is liquidity on a certain market. What liquidity is basically the ability to transform a given asset into cash with on the smallest time possible, with the smallest possible market impact, price impact. That is the essence of liquidity. So the most liquid asset is cash itself, right? Because you have it already, it's extremely liquid. And the way that we do this, if you want to sell your asset at a certain price, it rarely happens that there is on the marketplace that you're going to at the exact same time somebody that wants to buy the same amount at that price at that moment, right? And so the role of market makers is to bridge the gap. So when you want to sell, we are here to buy, and then so we're going to be holding that position for as little as possible, because we are delta neutral. And then when somebody wants to buy, we're going to be there ready to sell. And so it's really about bridging that gap between buyer and sellers to make sure that everybody can have access to as much liquidity as possible on a given asset at a given time.
All right. Okay, so Kevin, I'm gonna play dumb for 2 seconds. So because it's good to understand how you guys make money. So I'm a seller, and typically I want to sell higher, and then I'm a buyer and I want to buy cheaper. So if I'm a seller, I want to sell my asset at $10, and then the buyer wants to buy it at 5. So are you, Keyrock, gonna buy it at 10 and sell it at 5, and then you just lost $5, or how does it work then?
So no, we are makers, right? So we put orders in the order books that can be taken by others. So we're gonna be happy to buy at 9 and to sell at 11, to take an example of an asset with a very wide spread. And if somebody on the markets want to do the opposite transaction, we're going to be earning that spread in this case too, right? But so the nature of our risk is that as makers, we are always against the market because we are there in the books, we put orders, we are ready to buy at this price, sell at this price. But so when the market goes up and everybody wants to buy, we're selling. That's the nature of being a maker. And when it's the other way around, we're buying. Again, that's the nature of being a maker. And so the part where risk management comes in is that we need to make sure that we open orders in the market at an appropriate price with an appropriate amount and an appropriate kind of spread, and that we're able to adapt them very, very fast to adapt to the market. Otherwise, we are always on the wrong side of the market direction, which can indeed cause losses if you're not managing your pricing and your algorithms properly.
And so something that I believe a lot of us have been exposed to is, wash trading from less reputable players. So where is the line between ensuring, liquidity and kind of wash trading?
So wash trading is we don't create volume. That's the line is there. Wash trading means that you're trading against yourself. It means that, I have on a given exchange, Keyrock has two accounts. One is buying, one is selling. It creates volume, but that's completely fake because it's wash trading. So the line is extremely clear. We are makers. So it's what we tell all our clients. We're preparing the party, right? We make sure that there is an order book. It's filled with orders. The spread is tight. The outstanding liquidity is good. But if nobody wants to buy or sell the token, nothing's going to happen.
Okay.
We do not create volume, we create liquidity. So the line is very, very clear with wash trading.
Okay. Perfect. So I propose now that we move indeed into exactly, your business model. And well, one question that I have is, did you market yourself as a kind of a traditional finance market maker that is now, coming to the digital asset space, and this is where, you initially gain traction, or is it also a different type of industry?
I mean, I've never worked in market making in TradFi, so I don't know. To be honest, I mean, I don't know. That's not true. I do have.
That sounds like very unique.
I do have an idea, but no, we marketed ourselves directly as being native digital asset liquidity providers. That's where we started. I do think that it does come with a lot of differences. First of all, just because the market infrastructure, like you don't have a setup where retail users connect directly to exchanges in TradFi. You have some, 24/7 markets, but those are the exceptions. It's immediate settlement. All of the trading that you do on exchange has to be pre-funded. So there's lots of things that make this a bit different than what you would have on the market later on equity, for example. The volatility of the asset itself just being a major difference already. So no, from the start, we are starting this activity on digital assets. The reason we're creating the company is that we believe that all assets will eventually be digital, because all other things being equal, a digital asset is a better asset. So we believe this will replace financial markets as we know them, and eventually all assets will be digital, and we want to be able to provide liquidity at scale on digital assets. So from the start, that was the angle, and that continues to be the case 6 years later. Of course, with some things that have changed as to how do you tackle this problem, how do you achieve this objective, but that has always been the angle.
Okay, so just to add on this, so you have a high conviction about digital assets and tokenization. Can you kind of expand on that conviction? And do you mean that what we call real world assets, so non-digital assets, will become digital and then be tokenized, or what is your conviction?
So I think that a digital asset is a superior asset because it's easier to exchange. It's easier to trade and to exchange. If I take an example, you take an Amazon share, right? In its very traditional form.
Yeah.
I cannot buy it from you now. Like, it's not possible, right? There's multiple intermediaries, there's, different custodians, brokers, exchanges, that each take a cut potentially in the transaction. I cannot buy it from you today, even less so if we're Saturday or Sunday, or we are in completely different countries, or the transaction cannot happen. Even less so if I want to buy half of it. There's no way to do it. If that share, all other things being equal, right? So same information, a memorandum, same prospectus, same protections for investors, everything is the same. But that share is a token on the blockchain. All of a sudden, you can just show me a QR code on the camera. I scan it, we make a transaction, and I can buy a tenth of it, a hundredth of it, no matter what, 24/7 from everywhere in the world. So the fact that the asset itself is digital makes it a lot easier to trade and to exchange, and therefore makes it a potentially more liquid asset, and therefore potentially superior asset. And I do think that this logic is going to apply to everything. The same way that we move from a paper share to an electronic share, but that exists digitally only in the centralized database of a counterparty. Now we're moving to the next step, which is a fully digital asset that does not depend on the centralized database of a counterparty to actually exist. And so it's just a natural evolution as to how we represent value. And I believe that this concept adds value to any type of assets. And what we see with cryptos today are the first use cases. It's a bit kind of the cutting edge, like, look, those are all proof of concept of how value can be digitally represented. And that value is widely different from one crypto to another. You have Bitcoin, kind of digital gold, you have stable coins, you have utility tokens. They're all different type of values, but what they have in common is that they are fully digital, and it shows the amazing things that we can do once value is digital. And now you can apply that concept to all different types of values. And yes, that's equities, commodities, fixed income, but a bit further than that, art, digital identity, the data that you leave online, all of this is value that we can digitally represent. And so I think that eventually it's just a natural next step to have all value digitally represented. That's kind of the starting conviction.
I think that's very profound. My concern is that, isn't it then really a matter of how you can prove ownership, really, right? Because you have, okay, maybe we did a transaction, but if I go in the real world where I live in with my jurisdiction, and I don't know, we have a dispute, how do we kind of work with regulation to recognize ownership? I think that's a major barrier still.
Yeah, of course. That's why it's not, what I'm saying here is kind of an aspiration. It's not a reality yet, because indeed, for this to work, you need to have the blockchain on which this token representing an Amazon share is being issued. You need to have this blockchain recognized as the unique source of truth to prove ownership of that share. And that is not the case yet. And so that's why there are lots of barriers to be taken down in order for this to happen widely. But the reason that I'm so convinced that it will eventually happen is just that it economically makes sense. When this happens, you have an asset that is a lot faster, a lot cheaper to exchange, and at the end of the day, liquidity is something that all markets participants are creating.
Exactly.
Two assets that are exactly the same in every single aspect, but one you can transform into cash in a millisecond without any price impact is going to be a more desirable asset than another one that is not as liquid. And so something that is fully digital is simply economically make more sense, which is why I believe that we will eventually get there, notwithstanding the barriers that are currently still in between us and that objective, basically.
Yeah, really, that's the value about all this, is making the illiquid liquid and global. So do you believe, Kevin, that the future of finance will be on chain?
100%. Yeah.
100%. Okay, and is it correct that now the kind of only at scale use case is around cash and cash equivalents, or do you see it with more structured financial products?
The use case that we see, like currently, the use cases are basically crypto in general, right? And there you have lots of different things. But if you look at what is the biggest, what are the biggest, crypto assets that are currently exchanged and used around the world.
Stablecoin.
Stable coins. You have Bitcoin, of course.
Yes.
You have ETH, of course. It's also yet a different problem. So I don't think it's as restrictive as that. But currently, these are the ones that are the most used actually mainstream. And the question is, how do we go from this really kind of edge cases and proof of concept to something that is, potentially encompasses all real world assets?
Cool. So I've indeed noticed that you guys joined a coalition that it has, this purpose of bringing as many assets on chain as possible and generalized tokenization. I believe you're the only market maker that made it to the coalition.
Yes, indeed.
And so what will
We're
be
very good.
you're very you can be very proud about that indeed. So what will be your kind of unique contribution? What is the role of a kind of market maker and trading desk in that journey?
But so our role is we as market makers we have a very keen understanding of the digital markets infrastructure, different kind of pieces in the pipes and what is necessary for an asset to eventually be liquid. And so that is these 6 years of experience in making digital markets as liquid as we can. That's what we want to humbly contribute with
Mm-hmm.
to the purpose of the coalition, right? So it's really sharing this experience, share your understanding, see how that translates, for other types of digital assets than the one that are already traded now, and make sure that we can be an active contributor to get towards an objective of all assets being digital as fast as possible. And the reason for it, what is interesting is why is this interesting? And I believe that what is interesting is the optionality. Is the optionality between centralized and decentralized. I personally don't believe that everything will be fully decentralized in the future. I don't think so. I think that some things make sense centralized. Some things are cheaper and faster and safer potentially centralized. But the problem is when you don't have a choice, when everything has to be centralized, because the day you cannot trust those centralized counterparties anymore, that day you're stuck. And I think that if value is fully digitized, we start to have options. You can go centralized where it makes more sense for you, but you can also go decentralized when one day it stops making sense for you to completely depend on a counterparty. And this logic of optionality and of choice around value, how to store it, how to exchange it, is something that I believe is tremendously important, and which is why we are keen to contribute as much as possible to make that shift from centralized value storage, creation, and exchange was something that can be centralized or decentralized depending on what makes the most sense for you in the geography that you're in at a given point in time. And that optionality, having that choice, is something that we and that I personally believe is adds a lot of value to people in general, basically.
And do you believe that really decentralization is there? Because if I take, a retail user, you still need to, I don't know, open a wallet, place some money into a centralized exchange. If also, Keyrock starts operating on decentralized exchanges, the price can go completely haywire. So it doesn't seem like, it seems like the vision maybe, but in practical terms, very little things are actually decentralized.
But no, so I don't think that decentralization is there or not. I think that some part of the market are decentralized, others not, and that's fine. You don't need to do self-custody all the time. For some people that doesn't make sense, and so it's good that you have both centralized and decentralized options. It's up to you, but at least you have a choice. Same thing for price discovery. You can do it on centralized exchanges, you can do it on decentralized exchange, but what is interesting is that you can choose. So if you look at the digital market, is 100% centralized, 0% decentralized. When you look at digital assets, eventually, is it going to be 50-50? Is it going to be 30% centralized, 70% decentralized? I think that's going to vary depending on what people value most at a given point in time. Because when you have something that is super centralized, you have something that is potentially very safe, and you basically delegate your responsibility to a counterparty. But in exchange for that
Yeah,
comfort
safer,
and that
simpler.
convenience, you're
Yeah.
losing control, right? So
Okay.
when you value convenience and when you value comfort over control, it's great to go to something centralized. But when times change, maybe all of a sudden what you want is to make sure to have control and to not depend on someone else, even if that means that you have more personal responsibilities, more personal risk, right? Because you self-custody and so on and so forth. And so, which means that this balance, these preferences, they change
Yeah.
because it depends on your personal situation at a given point in time. Again, where are you in the world? Is there a war currently in the country that you live in? Can you actually trust that central bank? Can you actually trust that bank? Depending on all of these things, what you value most is going to change, and therefore the balance between centralized and decentralized is going to change. But the reality now is that in the legacy system, you don't have that choice.
Mm-hmm.
It
And
is
you believe,
100% centralized, and that's it.
yeah. So in your understanding, this space is fundamentally different. I'm asking because I've read as well, if you look at Bitcoin, if like the five largest holders were to sell, their Bitcoins, then the market would go to zero as well, right? So it's one could say it's as much as risk of being kind of manipulated or annihilated than any,
Of
um,
course.
yeah,
So I don't think it's fundamentally different. I mean, at the end of the day, it's you have people that are active on the market. People have their own personal incentives,
agenda,
and so
yeah.
part of it will be different. Part of it will not be different, depending on who's building it for what are the incentive behind it. But the difference is that this technology offers more possibilities. That doesn't mean that this technology is inherently it doesn't mean it's inherently bad. Some people are going to use it for shit purposes, and so it's going to be even worse potentially than what we see on traditional markets. And we've seen that over the last 2 years, right? Things that combine the worst of the two worlds with centralization, opacity, scams. We've seen it. So
Yeah.
the technology is not inherently good or bad. It's what you do with it. But what is interesting is that you can do more things with this than you could with the legacy system. And we just need to push to make sure that hopefully more good things are done than bad, but it doesn't make it fundamentally or inherently different. It's a tool, and the tool will be good or bad depending on who uses it.
Got it. Makes a lot of sense. Well, so now I wanted to go back to one of the activities that I noticed with Keyrock, which is that you launched an accelerator program. I believe you supported 8 teams, or at the end 8 teams won. Can you tell us more about that, and also what made you want to create an accelerator program for?
Sure. So I think that one of the fundamental differences between this market and the traditional market is the speed of innovation. Because it's decentralized, the barriers to entry, or potentially decentralized, right? It can be decentralized. The barriers to entry are a lot lower. So you see so many new things popping up all the time, and the very nature of decentralized finance is that it's composable, right? So every time somebody creates a new block, that block can be used by any other team to take part of it, add something on top, and so this composability of the technology with its decentralization makes that the innovation is just ridiculously fast. And so for us, the idea of this is twofold. One is to continue to be involved with very innovative teams that build new things every day and make sure that we are there involved with them for, to some extent, also our benefit, right? To make sure we follow up. Sorry?
Sorry, is it specifically in finance or across
So
verticals?
it's in our case, for us to launch an accelerator, we need to know that we're going to add value to it, right? Otherwise, us supporting a startup using blockchain technology for supply chain, we don't have much added value as a market maker, right? So
Yes.
for us, there had to be a theme where we could actually, there was actually a differentiation in joining a Keyrock accelerator versus another, and that was kind of the intersection of digital and finance. So it is where our focus is going to be. What we know is pricing assets, so there had to be something with a link to that. Otherwise, it didn't make sense to join our accelerator specifically. But so the first part of it is there's an idea of keeping in touch with innovation. The second part is really making sure that in a time where the market was a bit tougher, like when we launched like a year and a half ago, we started with the idea. The market was in a very different state, much harder for smaller teams to find funding, much harder to find support. Us having been there for 6 years, okay, this is a good time to support innovative teams that actually build things that make sense, because God knows we've seen enough things that do not make sense over the last 3 years that eventually blew up. So we want to support teams that build something that actually makes sense and make use of this technology. And so it's really those two things that led us to create the accelerator. We had, I think, over, was it 200 companies that applied, and from those we selected 8 that we believe were the most promising, and then we had a 4-month program with them that concluded in December last year.
Wonderful. And so was it remote, or I think they went to your office in Brussels?
Yeah, it was in person in Brussels. So it was 4 sessions. I think each session was like 3 or 4 days in Brussels, and 4 sessions over 4 months, basically.
And then do you end up kind of investing in them, or are you committed?
Yeah, so I mean, the idea indeed is to foster collaboration and in between, them and Keyrock, and that can take multiple forms, in between us becoming their client, the other way around, having a partnership, potentially taking the form of investment as well. So this is something that can, we try with all of the startup explore, that was also part of the program, is how can we concretely help once you launch, investment being part of it, but other collaboration being also on the table for each of them.
Okay, well, exciting to see how this progresses. Will you be doing another cohort this year?
Most likely, yes. So it's not something that we've announced yet, right? But most likely it's something that it's an effort that we want to continue. But there's something that will be officially announced, I guess, later in the year.
Okay. Sounds good. So fast forward to today, and the next, 2 years, what is it that keeps you excited that you're building? And I saw you opened an options desk. Maybe you can tell us a bit more about that and the need for that as well.
Sure. So the mission of the company is really to empower tokenized economies, right? And do that by providing liquidity. The question is, what do you provide liquidity to? Basically, we started on spot markets. We started on spot market on centralized exchange, because that's where there was the most activity and demand, when we started in 2017. That this is something that was expanded to decentralized exchanges as well, still on spot market. Then we saw more and more demand as well for OTC trading, so over-the-counter trading, so not on exchange, but counterparties trading directly with us. And so we opened an OTC desk, still on the spot market. But then what we see now is that there is more and more institutional demand for digital assets. Those more institutional profiles are looking for different types of instruments. Ones, that can have a more, I guess, tailor-made exposure to the market, potentially more capital efficiency as well. And that's where options, of course, are very interesting instruments. And so that's why we started to build our option desk actually 1.5 years ago. So we spent 1.5 years building everything in-house to make sure we had the best on the best of the best to be able to launch and be live since last month. So we provide basically OTC trading capabilities on options on a variety of assets, of course, all the major one, but also altcoins, and that allows us to provide treasury management solutions to holders of less liquid assets, and have really kind of a tailor-made approach with those institutions. So it's just kind of the logical next step for us in providing liquidity to digital assets that start to be in more and more shape and forms.
Got it. Yeah, if I replay that, so since 2017, you probably worked on more standardized offering that can scale, and as the market matures and there is more and more institutional adoption, you're now shifting to more custom, probably higher priced offerings that are also way more sophisticated and can
So I think it's not a shift, it's an addition. Basically,
an addition.
We're adding more and more capabilities to continue to basically address the needs of the market. Yeah.
Okay, and what would be the next frontier for you? So you have a VC arm as well, I believe.
So we do some VC investment, but honestly, it's not something that we. It's not the nature of our business, right? Yeah. So it's when you look at the accelerator, for example, there is part of it that is investment, but we're not a VC fund per se. It is not the core of our business, so it is not a core activity of ours, I would say.
Right. Well, Kevin, thank you so much for your participation today. It's been really a valuable discussion, super interesting. Before I let you go, I know our listeners are keen to know, where to follow you and follow Keyrock's incredible work. So where can they stay up to date on your journey?
So definitely on Twitter/X. So Keyrock is a Keyrock Trading. I'm at basically a Kevin de Patoul, and then LinkedIn, and on our website keyrock.eu. We also have a blog where we release a lot of, I guess, educational material on digital assets, on tokenized assets, on market making, on what we do at Keyrock. So I think that Twitter, LinkedIn, and our own site is the best way to follow what we do.
All right, perfect. Thank you so much, Kevin.
Thank you, Lizzie, for having me. It was a pleasure. Have a nice day.